Good evening, everybody, and welcome. Thank you for joining us this evening. I'm Julia Peloso-Barnes, owner and founder of Prism Planning and Solutions Group. I'd like to introduce the other members of the Prism team who are joining us on the call tonight. Brianna Skorvanik is our associate advisor, and Max Robinson is our financial planning analyst. Prism's mission is to empower you to pursue your dreams and passions while ensuring that you feel well cared for, informed, and secure. Several times a year, I give you an update on what I see in the economy and markets and how, if at all, that's affecting your longer-term portfolios, the portion that's invested to mitigate the effects of inflation and longevity. Tonight, I will be sharing my closing thoughts on 2024 and some of my expectations for 2025. We are recording tonight's call, and it should be posted on our YouTube channel by the end of the week. Let us know if you'd like to get a copy of it. Please see the end of the presentation for all of our disclosures and disclaimers. Prism Planning and Solutions Group is a DBA of Inside Advisors, a registered investment advisor. Advisory services are only offered to clients or prospective clients where Inside Advisors and its representatives are properly licensed or exempt from licensure. This material tonight is solely for informational purposes. Past performance is no guarantee of future returns. Investing involves risk and possible loss of principal capital. No advice may be rendered by Inside Advisors unless a client service agreement is in place. The presentation tonight may discuss different ideas and strategies, but none of the ideas shared should be interpreted as a specific recommendation for any individual. We only provide advice to clients with whom we are engaged and for whom we have done a financial plan. If you'd like to learn more about working with us, please feel free to visit our website at ppsgrp.com. We do encourage our clients to invite their friends and family to these presentations when they believe the topic may be of interest. So if you know someone you'd like to be added to our mailing list for future calls, please let us know. During the presentation, we will mute everyone, and then we'll open up for Q&A at the end. So let's begin. What I'm going to go through this evening, and I'm going to go pretty quickly. I've ended up with quite a few slides. Some of them are transition slides, not all content, but I'm going to go through things pretty quickly about where we are now, what I see in 2025 and Trump 2.0. As most of you know, I have put out a couple of blog posts as well. We're sharing some of my thoughts there. Talk a little bit about what I'm watching, what I'm hoping for, what I'm concerned about. What do we do with our portfolios, and then talking about our process. So again, let's talk about where we are now. The Fed's preferred inflation data point, as you know, is the PCE. These came out at the end of November, and by all measurements right now, inflation seems to be back down into acceptable and normal levels and is also pretty stable. These are the year-over-year numbers, both for all PCE, which includes food and energy, and core, which does not. And you can see we've now been consistently in the 2.5% range for nearly a year. There is pain when we go to the supermarket, and that's really a hangover from the housing crisis, right? So back in 2008, the Fed essentially cut rates to zero, right, when the housing crisis caused a near collapse in the economy. You've heard me talk about for years the work that's been done by Rogoff out of Harvard that shows that over 800 years of financial market history, when there is a crisis that is driven by debt, right, too much debt, it typically takes 8 to 12 years for an economy to heal, right? We were all set to actually start raising rates in 2020 and going back to normalize when the pandemic hit. We had almost zero inflation for at least 12 years. I went to the Bureau of Labor Statistics website, and there's a calculator there where you can look and see, you know, if I had $10,000 20 years ago, what will it buy today? And from that, with the magic of my little HP12C, we can calculate the average inflation rate. So right now, we are experiencing a lot of pain compared to where we were 5 or 6 years ago when we look at the prices of things. But when you look at the last 20 years, the average inflation rate over the last 20 years is just over 3%. Okay. When you look over the last 111 years, it's 3.15. So what we're really paying for now, and it doesn't change the reality of our checkbooks, but when I try to put the data in context, what we're paying for is 12 years of really having 0% interest rates. The good news is we didn't have a depression. The bad news is we're now playing catch up with this. The Fed does seem to have engineered the desirable soft landing, right? Which is where they can raise rates without throwing us into recession, and then be able to cut rates when we've reached a slowdown in the economy that's desirable. Because remember, the Fed increases interest rates to slow down the growth rate in the economy to avoid too much inflation, right? They made a commitment to bring inflation down. They've done it. There was a lot of fear that they were going to keep rates too high for too long, which would tip us into a recession, which has happened many times in the past, right? Federal reserves can be very conservative about wanting to avoid inflation, and sometimes they keep rates too high too long. That has not happened in this cycle. Obviously, we don't know what's going to happen in a year. Some people will say if we have a recession 24 months from now, they'll still say it's tied to this. I think there's a point at which we have to not connect something from 4 years ago to what's happening today when we try to assign blame for decisions. But what we see right now in the yield curve is that the inversion of the yield curve has corrected itself, right? We went for a period of about 2 to 2.5 years where short-term interest rates were higher, right? The 2-year Treasury was higher than the 10-year Treasury. That's an inversion. That's been a flashing red indicator of an impending recession for every cycle or almost every cycle since World War II. That has not happened. The yield curve is back to a normal shape, right, which is longer maturities, have higher rates, and we actually now have positive returns on the 10-year Treasury, as you can see here. So it appears as if the Fed has managed to deliver the soft landing that nobody thought they could. We've also seen a normalization in unemployment rates and wage growth. We are still looking at an unemployment rate that is below historical averages. We are looking at wage growth that is slightly above historical average. They're both converging over here. What's interesting about this is that each time in the past, going back to the 1970s, the last 50 years, that we've seen them converge in this way, it's usually been followed by an increase in unemployment, right? So this is the cycle. Is it going to repeat again? I think probably, just for a little preview, and I'll talk a little bit more about why. But we are starting from low rates of unemployment and reasonable rates of wage growth, right? Still playing catch up, but there's a normalization there as well. I am a little bit concerned about both valuations and concentration. You've heard me talking about this before. With interest rates being below average, that creates a scenario that the price earnings multiples can be higher than average because there's a relationship between those numbers. Interest rates are a discounting mechanism. I'll spare you the time value of money lecture today, but if interest rates go lower and stay low, that creates some space for PE ratios to be higher than average, right? But that doesn't mean their trees are going to grow to the sky. Valuations right now are well above historical averages. You can see over here that the top 10 holdings in the S&P 500 are currently trading at 28.8 times earnings. And the rest of the stocks are trading at under 20. And the index itself is trading a little bit over 22. The average of the top 10 is 20 and a half. So the top 10 are trading at 140% of their average. The index is trading at 133% of the average, and the other 490 stocks are trading at only 124% of average. So everything's above average. And that, I believe, is a function of low rates. But the concern we have with this kind of pricing is we could end up with a lost decade. The last time we ended up with these persistently high valuations, we did see a decade of almost zero to slightly negative returns. We currently have the top 10 stocks in the S&P 500 comprising 36% of the index. The other 490 are making up the other 64%. So these are concerns that are going to eventually need to be addressed. The market will either do it on its own or it'll be forced by economic circumstances. Markets can stay irrational for an extended period of time. Mag 7 does continue to drive the headlines, but we are starting to see signs of earnings growth in the Mag 7 slowing down, while the earnings growth of the other 490 are starting to accelerate. So that's good, 493, I should say. But what's happened is that, as happened in the late 1990s, our expectations of performance have been very much skewed by what these Mag 7 have done, right? So the other 493 have delivered about a 14% return year to date, and yet it seems like underperformance when you compare it to these technology stocks. But I'll bet if I had said to each of you 5 years ago, right, we're going to get 14% a year for the next 5 years, you would have been very happy. So we need to be conscious of our expectations, recognize there can still be irrationality in the market. As I mentioned, trees don't grow to the sky. We are approaching the peak in multiples that we saw in 2000 rather. The PE ratio at that point was 25. You can see the steepness of this climb, right? Without even getting into much of the math around this, it's not a far leap to say, you know what, we may be getting ahead of ourselves. Now, the reality is that bull markets need to end by something external happening, right? So we say they don't die of old age. It's some sort of external event. But if we do start to see the increase in 10-year treasuries persist, right? They were up almost half a point last week. And depending on what happens, particularly with the deficit in the next 12 to 18 months, if that 10-year treasury rate does start to drift upward and stay there and look like it's going to stay there, that could put pressure on PE ratios, which could force the price of stocks down just to bring the multiple down, even though there's earnings growth. Okay. There's a lot of math and how that works. I'm happy to talk about it further if anybody wants, but I will spare you the rest of the math right now. As you know, I look at credit markets. Credit markets tend to see things before the equity markets do, right? There's an old saying that all the optimists go to work on the equity side and all the pessimists go to work on the credit side, the fixed income side. One of the things that we're watching for signs that there may be a break coming in the market is what the high yield market. These are the lower quality businesses. What we're seeing here is when these lower quality businesses are going to be facing refinancing their existing debt, because that's a point of potential pressure. It's really not going to start kicking in for another 2 years. So that gives us more lead time in the economy, more time for these companies to adjust to whatever's coming and changing. Markets hate surprises, right? But if there's plenty of warning about what's coming, companies and markets can adjust. And that's what we're watching for. Another advantage, if I can put it that way, about where we are now is that in the composition of the index over here, the overall credit quality within the high yield space is higher than it was in 2007. The implication is there's less risk, right? There's less risk of falling off a cliff, or we have more ways to go for that to deteriorate before we have a problem in the economy. Default rates are well below our historical averages. But these items, right, the refinancing that needs to be done, the credit quality of the index, and the default rates, those are our canaries in the coal mine. So that's what we're going to continue to watch. Now, a little bit of history, and this is about economics, not politics. What we know from history is that prolonged economic stress does lead to political change, right? And we saw in the world in the same era, nearly 100 years ago, major changes politically. In the United States, right, we had the Roaring 20s, and then after 3 successive Republican administrations, we had the Depression, and populism was on the rise. Populism is an approach to policy and getting elected that focuses on the kinds of policies that make individuals happy, right? Things that put money in their pocket, things that are going to improve their economic situation. After an extended period of economic stress where people have struggled economically, even though they may know that certain policies are not necessarily the most rational or the best for the country, right? They become much more interested in what's going to affect them as opposed to the country as a whole. So, for example, if we were to say to people, look, as a country, we can increase our debt, right? And we can bring the price of eggs down by increasing our debt, right? When people have been feeling reasonably confident, a lot of people are going to say, you know what? I can pay a little more for my eggs. We shouldn't take on more debt as a country. You get to a point where people have had 10 and 15 years of incredible economic stress, of falling behind, of barely making ends meet. Everybody has a point at which they're going to say, you know what? That's great for the country, but I got to put eggs on my table because I got kids to feed. So do what you got to do, government, right, to make my life better. And populism comes both from the left and the right. In the United States, right, we had Republican administrations, and it was about throw the bums out, right? So we had a populist from the left elected, which we then resulted in the New Deal policies and so forth. And I use Germany as an example because it's a very extreme and obvious example. Following World War I, the Treaty of Versailles, right, crippled the German economy, and then the global recession that was created by the Wall Street crash in the United States led to a falling off a cliff, right, economically in Germany, a 39% drop in wages. So people were done, right? The Weimar Republic, a democratic government in Germany, had been trying to put things back together after World War I. People were done, right? So there was a messaging from, it happened to be a right-wing party at the time, but the messaging was focusing on supporting the working class. It was interesting when I was doing my research tonight where the role of elevating women as mothers was a significant part of the campaigning that was done at the time by the right-wing party. And I can speculate about why and human nature and all of that, but it doesn't really matter. The point is, after extended periods of time of economic stress, people want a change, and they change government. And they're no longer focused on philosophy. They're focused on who's going to help my bottom line. When you look at what's happened in this country, we have seen a 40-year decline in economic security. And again, I want to acknowledge and thank JP Morgan Asset Management for all these great slides and data. They've been putting this data together for years. Back in the day, we used to get a physical book with all these slides, and now it's all available online, so I can grab it and show you. But these two charts are showing that in 2023, as an example, the top 10% of earners in this country spent about 2/3 of their income. All right. And obviously the rest they got to save. The bottom 90% were spending 98% of their income. Right. So if you think about the impact on savings, and that's basically living paycheck to paycheck. So 90% of the population in this country in 2023 was essentially living paycheck to paycheck. When you look at the share of income, which is on the right and in blue, and the ratio of financial assets to GDP, you can see very clearly what's happened, right? This is the 40-year period. And this has created a tremendous amount of pressure on most Americans, and they're demanding change. At the end of the day, it's always about the economy. Okay, it's the most basic of need to put food on the table and a roof over our heads. And that's what people have voted on and decided. So what are we likely to see in 2025 and Trump 2.0? Some things are going to happen more quickly. Some may not. Some may not happen at all. So the things that I think are likely to happen fairly quickly. I've talked about this a couple times over the last year or so. I believe the Fed is going to change its target inflation rate. It's going to raise it. when inflation went up after the pandemic, the Fed said, we're committed to bringing inflation down to 2%. Now, after the housing crisis in 2008, they had a target of 2%, but they were trying to get it up to 2%, right? And they kept interest rates at zero, trying to get it up to 2%. We called it pushing on a string. They used that 2% number because it was really, really important to tell the market that the Fed was absolutely committed to getting control of inflation and not allowing long-term expectations of higher inflation to get ingrained in the market. But it's too low. It's not a realistic number, in my opinion, based upon what I know and what I've seen. Historically, you remember the 111-year numbers, like 3.1 something. So I think that one of the things we're going to see pretty quickly in 2025 is the Fed is going to change its messaging to a target rate more in the 2.5% to 3% range. It's probably not going to happen all at once. It's probably not going to happen with a huge headline. It's probably going to be buried in some of the minutes of some of the meetings. And there's going to probably be a very wonky statement that's going to have a very nuanced tilt to it when they talk about changing their targets and the data they're going to be looking at. But I think that we're going to see that target move back to its long-term average, right? Because the market now accepts and knows that inflation is back under control. That doesn't mean the price of eggs is going down anytime soon. It means the rate of increase is back to a more normal range. And when you average out over time that we had 12 years of essentially no inflation, we're back to our long-term averages. Okay, so I think that's going to be a really key message. The other is going to be a reduction in regulations from almost all agencies. Now, we've got two things going on here. The markets are already anticipating increases in profits due to this reduced regulation, right? Because if companies don't have to spend money complying with federal regulations, whether it's about safety or the environment, whatever it is, right? Or even just paperwork, right? Everyone's got to do paperwork to comply with some regulation or another. That's going to drop to the bottom line. And so the market multiples are anticipating higher profit margins. However, when we look historically, right? And this is again, these are a lot of data points, but what this is graphing, what both of these charts are graphing is when you have multiples, right? The PE ratios on the S&P 500, where they are today, what has happened in the past, both on 1 year and 5-year annualized returns. And the short answer is in both scenarios, they've tended to be close to zero. We had this happen. We had a lost decade when we had, again, you have several years in a row of above average returns, we're going to have to get back to average somehow. So we're going to start to see these two things come into tension. I think the market is getting a bit ahead of itself on the potential profit from reduction in regulations. And the result is we're at risk of having, 26 and 27 have close to nil returns unless something else changes. All right, so I think we're going to start to see these numbers talked about pretty quickly. One area that I think could easily end up being more talk than action is this Department of Government Efficiency. Now, there are definitely things that are going to be talked about and I'm going to try to do. But this idea of reducing fraud and waste is not something new, right? Every president of the last 20 years has come into office saying, we're going to try to do this. And right now, there seems to be a focus on saying, we're going to come at this from a different angle and talk about reducing the federal labor force. Well, I found something very interesting in preparing for tonight's call. We have roughly, and it depends on how you count military and postal service in or out, but we have roughly 3 million federal employees. And it's the same number we had 30 years ago. Okay. What's happened is that the expansion has occurred in private sector contractors. Okay. Depending on how you count the numbers, there's another 2 or 3 million people doing work. Okay. That is the work of the federal government, but when contractor relationships, so they are not federal employees. Now, what's interesting about this is that there's going to be a bunch of tension, right? SpaceX is a great example, which has got billions of dollars of contracts because the government has outsourced a large portion of our space program, right? And so that's an example. It's federal money going to contractors to pay people to do work that used to be done by federal employees or could be done by federal employees based on the belief that the private sector is more efficient with it. So I'm not sure if there's going to be as much to reduce in terms of staffing of federal employees as the headlines suggest. Also, at the end of the first Trump administration, they were talking about taking advantage of, call it a loophole, that would allow, by executive order, the president to recharacterize about 50,000 employees and allow them to be fired, right, from civil service. Biden administration early on worked with Congress to get a law passed and put all the processes in place that say that's not going to be able to be done by executive order. So if there's a desire to change the status of some of these employees in order to make them easier to fire, there's going to be months of challenge associated with that. I'm not sure if that's where the administration is going to invest their time and energy. Okay. To really achieve the financial objectives that this group is talking about will require changes to Social Security, to Medicare, and programs such as SNAP and Medicaid. The things that are being talked about are privatizing Social Security, the same things that have been talked about for years. Raising the full retirement age, increasing the wage base, changing the COLA calculations. I don't know right now what's really going to make it all the way through the system because I think that each of these is going to run into the same roadblocks they've run into before in Congress, right? The president can't just do these things by mandate. I think they're going to test the limits of what they can do. But I think as they start to get into the nitty-gritty of this, there are going to be some questions. There has been movement in the past, within the last 40 years, to privatize Social Security. I suspect that discussion is going to come up again, but I'm not convinced it's really going to go far enough down the road to make a difference. Medicare is another interesting one to look at. Because again, this is about who stands to benefit or lose. About a third of what is spent on Medicare is spending on drugs, right? Which is going in the pockets of the big pharmaceutical companies. I think if this Department of Government Efficiency starts looking for ways to cut money, pharmaceutical companies are not going to be happy and they're going to push back. Now, the Inflation Reduction Act did start to allow Medicare to negotiate prices. The fact that Medicare can't negotiate prices is the problem, right? So it would be interesting to see how this plays out because if they're really serious about cutting money in Medicare, a great way to do it would be to accelerate the ability for Medicare to negotiate prices, which is in essence building on legislation that was passed under Biden. And so therefore it's probably not going to happen that way. But it's going to be really interesting to see as they start to look at the nuts and bolts of this. All right, pharmaceutical companies that could stand to lose hundreds of millions of dollars are not just going to say, okay, fine, we'll do that. There's going to be pushback. And I think that's going to be more challenging than they expect. Now, changing the accessibility to SNAP and Medicaid benefits are the so-called low-hanging fruit. However, the voter base that was most significant in electing this administration, right? If you think back to my conversation about economic stress, those people are disproportionately using these benefits as well. That's a needle to be threaded. I'm not sure if they're going to take this on head on, and these ideas pop into my head. When you look at the target date for this group to make its recommendations, it's the middle of 2026. So that allows a lot of campaigning around the 2026 midterms to take place. And if this group comes back and makes its recommendations in the middle of 2026, nothing's going to get implemented before the midterm elections. And that sets up several interesting things politically about not taking responsibility for not getting stuff done and who they can blame and all of that kind of stuff. So I think that there are things to suggest that this this Doge, this Department of Government Efficiency, which is, kind of a joke on Elon Musk's favorite cryptocurrency as well, could end up being more talk than action. Um, the big headlines, which, and again, we've talked about before, are your tariffs and deportation, what they're going to do with consumer costs, and then we're back to the midterm elections. We've seen a reduction in the expectations related to tariffs. I don't think this is going to play out for the reasons I've talked about in my blog posts. Again, there are American companies that stand to lose tens of millions of dollars or hundreds of millions of dollars because of the impact on consumers if these tariffs are put into place. They're not going to say, thank you, sir, may I please have another. They are going to push back. Mass deportations is the same thing, right? We get to a point where a lot of the meat processing companies in our country are using a very large proportion of their labor force as migrant labor, okay? So if there are raids on those facilities and people stop coming to work because they're afraid, even if they're here legally, but they're afraid of getting caught up in one of these raids, and now all of a sudden there's no meat on the shelf in the refrigerator at the supermarket, okay? That's not going to go over well, particularly with the people who are looking to see grocery prices come down, right? So I think there's going to be a lot of pressure to push back, and these are more going to be negotiating tactics, okay? We're already seeing a pivot in the promise about bringing down consumer costs. I think there was a conversation yesterday where he's talking about, well, it's really harder to do. And what he's now pivoting to is saying, well, all the other things that we're going to do to help the economy grow and the tariffs that we're going to collect are going to lead to the market naturally bringing prices down. Anybody who's taken any economics classes could refute 90% of that conversation, right? Just with a little bit of knowledge and history. So the question becomes, when the people who are already struggling economically don't see those prices go down, how are they going to react? Traditionally, when a single party has both the White House and House of Representatives and Senate, they really get about 8 months to do anything they want to do, right? Because in August, Congress people go home, they spend time with their constituents, they hear what their constituents are concerned about, and they come back after Labor Day with about 13 months ahead of them to campaign for their next election. And every politician wants to get reelected. That is their number one priority. I don't care which side of the aisle they're on, right? Obviously, there are exceptions, but this is what the majority of it is. Our system requires everybody in the House of Representatives to run for reelection every 2 years. So after Labor Day, they are going to be more focused on what do they need to do to get elected again than they are on any kind of broad ideological types of policy changes. So if they go home and they're hearing from their constituents that the promises of lower grocery prices and lower rent have not materialized, they're going to come back to Congress in September with that on their minds. And they're going to be thinking about what do they need to say and do to focus on their own reelection. And that is going to interfere with the ability to get things done, just as it has with every previous president in that situation. Crypto. I could do a whole other session on crypto, which I'm not going to do. The key question is from a pricing standpoint, will it become part of our strategic reserves? The price of Bitcoin in and of itself is a function of scarcity, right? There's a limited number of them. If you want to buy one, you have to find somebody willing to sell it. It's not like there's a warehouse full of these things, right, that anybody can go in and just take some out. So the pricing of it is it's purely speculation right now, okay? Cryptocurrencies are not backed by any individual country's central bank, and that has a lot of appeal to some people, right, for a variety of reasons. But it does cut both ways, because if something goes wrong, there's no central bank to step in and bail it out. Now, just as in the 1990s, this is a technology that is going to change things, okay? I've talked about this for a couple of years. We're going to drive central banks towards digital payment systems. When I started in the business, right, if you bought a stock right, on Monday, you didn't have to show up with payment for settlement for 5 business days. We just went into this year, we just went into T+1 as settlement. So you buy something on Monday, you settle it on Tuesday. The market wants us to get to instantaneous settlement, immediate settlement. The technology underneath cryptocurrencies is going to get us there, right? And we're going to see central banks moving towards adopting this technology and digital payment systems. And what's going to happen is they're going to take away a lot of the appeal, right, to some of the people that like to use this because it is very appealing to people who want to stay off the radar, like criminals. It's the same reason they stopped printing $1,000 bills and $500 bills because they found criminals were using it more than the average citizen, right? So that's going to have an impact when it comes to the pricing of Bitcoin and other cryptos. I do think it's likely going to end in tears for many. In the 1990s, we understood the internet was going to change everything, right? We didn't necessarily know how. We didn't know who the winners and losers were going to be, but we knew it was going to change. So everybody wanted to get in on it in some way, shape, or form. But a lot of people lost a lot of money. Okay. I don't need to rehash that here, but the people that were in very early took their money and got out. The people that got in later typically lost more money than they ever made. So we need to be careful. The cryptocurrencies that exist today are unlikely to be the long-term winners based upon what we know about history with innovation and technology. The underlying technology is a part of our disruptive growth portfolio, and it is a very important technology. But I can't see there being any significant amount of crypto in our reserves. So what am I looking at, right? And the goal is clarity. And I went back to this because we need to watch as some of these things play out. Chaos can be exhausting. We all know that. I'm sure that many of you have reached the point you just want to turn off the news. You're tired of, what are today's headlines? And what happens in that scenario is people stop paying attention. People stop paying attention, it allows things to happen, and that by the time we know about them, they're much more difficult to undo, right? So this is something I'm a little bit aware of. There were also tactics, and we saw this in 2010 in the euro when Greece was having financial difficulties, and Angela Merkel suggested that maybe the eurozone or the Euro bank should send in non-Greeks to help get the books in order in Greece. Well, you can imagine how that went over. But it made whatever the next suggestion that was made seem reasonable by comparison, right? We've had a situation with some of these proposed cabinet appointments, one in particular that was incredibly outrageous and so outrageous that the replacement choice seems very reasonable. But yet, if the replacement choice had been the first choice, I'm not sure if people would perceive it as very reasonable. So I think there's a very deliberate strategy to do things like this, and it is going to move people's idea of what is reasonable, and it's something we need to pay attention to, but it is exhausting. We can all agree that there's probably some waste in government spending. When this occurs in the private sector, corporations are known as we use the metaphor cutting muscle when they're trying to trim the fat, right? So when a company tends to they lay off people and they're trying to cut expenses, they always end up losing people that they didn't want to lose. They've got to go out and rehire people, right? There's got to be a period of rebuilding. This is very likely to happen as they cut back on federal workers, but the loss of institutional memory in the government, I think, is going to be much more damaging than what happens in corporations. There's going to be an opportunity, yes, to restructure some of these agencies, prepare them for the 21st century, get rid of some of the regulation that is still there just because nobody ever bothered changing it, and position ourselves for more nimble movement in the next century. But there's obviously danger as well. So paying attention to how this is done, this is probably one of my biggest concerns. The reality is, I think that those that have very high hopes for the changes to come and those that fear the changes are not going, nothing's going to live up to those extremes. I think the reality is we're going to end up with something in the middle. I do believe, you heard me talk about this before, that our government structure is the best designed in human history. Republics tend to slide into dictatorships on average at about 225 to 250 years. There's a lot been written on why. It usually relates to a combination of people wanting more from their government and somebody who exploits that to consolidate power. Our government was set up with that very human tendency in mind, right? Our government was set up as a response to an overreaching monarchy in King George. The founders wanted to do everything they possibly could to put checks and balances in place so that when those people came along that really wanted to consolidate power, that wanted to give in to their most authoritarian instincts, that were smart enough to figure out ways to manage the system to do it, and that was coupled with, economic stress, that it would be very, very difficult. So I'm optimistic about that. One thing that's going to work, I think, in favor of not losing our structure is that there are conflicting interests, right? The players at the top, you would call them oligarchs. I've talked about the companies that stand to lose a lot of money. If there's mass deportations, I mean, there's a lot being talked about around these things. They're going to push back. Okay, so those conflicting interests, right, are going to create some tension at some point. There's an old adage, the enemy of my enemy is my friend, and that means we can have coalitions of people that come together. I think I wrote about Bernie Sanders and Elon Musk both agreeing about cutting defense spending, right? And after you look out the sky to see are pigs flying, when you think about Elon Musk and Bernie Sanders in alignment, so yeah, they're in alignment on this issue, but they start to work together on a lot of other things, and they're more than likely the conflicts are going to prevent significant change. There are different skill sets required. We know that this group is a very effective campaigners. I'm not sure what we're going to see in terms of governance. And the reality is, and this goes back to the 2026 elections, voters are demanding and fickle. So I am very confident that when our congresspeople are back in their districts in August, and people are not experiencing the relief that they expected and were promised, they're not going to be happy. There's going to be some relief because you just look at the inflation numbers and things that the Inflation Reduction Act are starting to flow through the economy, but they're not going to see the price of eggs and the price of rent going down. We would need a recession for those things to happen. Okay, and we're unlikely to see a recession at some point in 2025. Obviously, there's always something external, exogenous that can happen, but there's nothing in the economy to suggest that. So, what do we do now? We dance with who brung us, right? Same thing I've been saying for years. Keep our cash reserves to protect against market volatility, stay diversified. Stocks are still going to be the only thing in town that's likely to outperform inflation over time. We know what potential volatility looks like in a 1-year period. We're going to see this, but we know that we hold for the long term, right? The volatility gets muted and we get paid for taking on the risk, right? So we're going to continue with that overall philosophy. Nothing is changing in our core investment philosophies. I still believe that quality businesses measured by free cash flow and dividends, especially dividend growth, are going to do well over time and are more resilient in times of stress. The two most important tools you have in risk management are time and cash. Making sure that you have enough cash, and this is why we always talk about your cash flow needs, right? And we set aside at least 2 years worth of spending, anything you know you need to spend, and an emergency reserve, because we don't know what's going to happen with markets. You need to give yourself the time to wait if we need to liquidate something out of the market for something unexpected that comes up. That's why we have cash reserves. After time and cash, then we diversify your portfolio. But what we've seen in the last 20 years is in times of stress, right? All correlations go to 1, which means the things that are supposed to diversify, and we used to say, well, if Delta goes up, right? If the price of oil goes up, Exxon goes up and Delta goes down. Well, it doesn't quite work that way anymore for a variety of reasons. But that's the reality we see in the numbers. So you can have everything go bad and be bad for a period of 3, 4, 6 months. So as long as you have cash set aside that you can ride that out and you're not forced to sell, we'll be okay. 3 rules, okay? These haven't changed. Fed always wins. Fed is the 800-pound gorilla in the room. Fed wants rates to go up. Rates are going to go up. So we need to keep in mind what happens when rates go up. Don't fight the trend, right? You saw a couple of those graphs. There's very, very clear trends in place, right? Bull markets don't die of old age. Something has to happen to change that trend. So we're not going to bet against it. And once everybody knows something, it doesn't work that way anymore. You notice I have put nothing in here about what happens in the year after elections for 2 reasons. One, I think this is a bit unprecedented, right, in terms of predictability. But the other is all of that data is so ubiquitous now that it doesn't work anymore, right? Because everybody's looking for the thing that nobody else has found yet, right? So if we keep those things in mind, right, when we make our investment allocation decisions, then we fold in what I think are some of the likely themes in 2025. Dollar strength is going to continue. I think policies are going to support that. We will continue to invest in non-US companies, but we will protect ourselves against currency risk, right? We do that in the portfolio now. We have a split. Some of it is hedged, some of it is not hedged. We'll continue to pay attention to that. We're going to continue to overweight stocks versus bonds, US over non-US. Probably going to see some changes. I'm waiting to see what comes out of Wisdom Tree at the end of the year. My guess is we're going to see a reduction in exposure to emerging markets. We're going to see a reduction in exposure to non-US smaller companies. We're going to probably see a little bit more of a shift towards larger companies. I have 2 charts here as we wrap up that show some of what's happened in the markets. We're seeing more companies staying private longer, and we're seeing some of the smaller companies that have traditionally had some of the growthier characteristics being disproportionately represented in the private sector, which means that a very, very large percentage of small companies are actually not profitable, and that's going to present issues. So this is looking at earnings data by market cap. Okay. So over here in this upper, my right-hand corner, right now we're seeing about, excuse me, 43% of small cap companies are not profitable right now. Those are levels that are normally associated with crises periods, the tech bubble, 2008 financial crisis, the pandemic. Okay, you can see that larger companies and even mid-sized companies are seeing a different trend. There are a much larger percentage that are profit. So there's a lot of pressure on smaller companies. So I'm expecting that we're going to pull back and be well below our averages in terms of allocations to small companies. These forecasted earnings growth numbers look good, but I think that, they're just overly optimistic. And a lot of those are being driven by math saying, well, valuations are down now, they're going to have to go up. And I think they're all going to come down in small companies. So I expect that we're going to see that change. We're also seeing, and there's a lot on here as well, but what this is showing you is over here, the number of listed companies, publicly traded companies, has gone from about 8,000 at the turn of the century to now being down below 6,000. Okay. So that means there's fewer companies whose stock you can buy. So if you think about supply and demand, we have fewer shares and more money chasing them. That has led to some of the price inflation. We're also seeing market cap just so much higher, right? So you have fewer companies that are smaller. This is showing you when companies go public, and what we're seeing is how long the companies have been in existence when they go public and what their valuations are. And back in the 1980s, you typically would have a company that might go public after 8 years in business, but it raised a very small amount of capital, its initial public offering. In the last 20 years, we've seen the average age or the median age of companies going public, raising money from the private markets or public markets to be about 11 years. But when they're raising money, they're raising almost $2 billion. Right. So the small companies are tending to stay more private. The Russell 2000 is a small cap index. You can see that most of the companies where the big growth is in the tech sector are staying private. And that means most of us don't have access. So you've heard me say this before. We cannot control outcomes. We can only control process. We will continue to focus on our planning process, right? Which is focused on you. What are you trying to accomplish? Where do you stand now? Are you on track? If you're not, what can we do? What suggestions do we have to help you get on track? Okay. And then looking at different allocations based upon your overall comfort with risk and volatility. Okay. We've talked about these. We'll continue to talk about them. There'll be some tinkering, I'm sure, within these, but I don't expect there to be significant changes in the overall allocation between stocks and bonds. The changes will occur in what kinds of stocks and possibly what kinds of bonds, but I think most of the changes are going to occur in the stock allocations. So with that, I'm going to open it up for questions.
Hi, thank you so much for this presentation. I guess one of the things I'm wondering about is, so we're seeing unemployment at a low, and, we're seeing that, the number of jobs created is going up and everything. And then this is one of those things where I see with my own eyes something different, right? So I'm seeing a lot of my tech friends getting laid off, and not being able to find jobs. And for some reason, jobs in IT, and particularly in software development, are thin on the ground right now. So there's a disconnect there, and it makes me understand people a little bit better because, what they're seeing with their own eyes versus what they're hearing on the news is different. I mean, what do you make of that? I mean, unemployment at record lows, but yet the people that don't have jobs. I mean, how do you reconcile those two things?
Thank you. That is a great question and a great segue to an important conversation. Statistics are problematic, right, for a bunch of reasons. And you always got to look beneath the surface. And that's a big factor of what's going on here with these statistics. There are a couple of different things. One is when you look at where most of the new jobs are being created, they're being created in service and relatively low-paying sectors. I have noticed in just being out in the world, right? We are seem to be moving towards an economy in which there were people with money and there were people with jobs serving the people with money. Okay. So a lot of the higher paying jobs, we're seeing corporations cutting those jobs, right? And even though the unemployment number itself may be low, if you start digging into what I call the underemployment or the shadow employment numbers, people are not fully employed. And fully employed means, right, where there were their earnings potential, where it was. We've gone through these cycles over the last 20 years several times where I've said things like, if you're over the age of 50 and you're not fully employed, you are unlikely to be so ever again. And I think that's the wave that we're seeing now. For the last 10 years, there was a lot of hiring in tech. And supposedly during the pandemic, these big companies were just even parking people. So they didn't want them to go to the competition. And there was a lot of overhiring. Tech is a great example, where they're laying off. But those jobs are going away. In our industry, technology has done this. There used to be, when we used to have the New York Stock Exchange, and the floor of the stock exchange, there were a lot of people employed in the functioning of the New York Stock Exchange, right? As some of those jobs began to be replaced by technology, the people that had done those jobs well and had skills aligned with those jobs did not have the skills to take the jobs that were now available. So this is an ongoing transition in the economy, in terms of what kinds of jobs are available. So and I think the service jobs are a big part of it. They're low-paying jobs. The people who are I don't know if 50 is the right age to put it at right now, but let's call it 50, were educated and trained and brought up in an environment where their skill sets were for an industrial economy that was beginning to use technology. Okay. But that's not where a lot of our economy and economic growth is right now. Most of the job growth is in service related industries, which are relatively low paying. So I don't know if that answers the question adequately.
Yes. Thank
Okay. Thank you. Natalie, yes. Oh, Natalie, you're on mute. Can you unmute yourself? There you go.
Trump's tariffs, what will the impact be on the stock market? I mean, is there any way of predicting?
Well, what we know from, I'll call it Economics 101, is that tariffs are taxes. Okay. If these, tariffs will raise the prices of goods that Americans buy. I mean, that's just a fact because I'm a company in Europe and I make widgets and I export my widgets to the United States. And when my widgets arrive at the port, they're going to charge me an extra 25 cents for every widget. Well, I'm going to raise my prices. I may not raise it by the full 25 cents, okay, but it's going to cause prices to go up. And so we're going to see the laws of supply and demand and prices. I mean, that's kind of the simple answer, because we're all going to end up paying it. So I think that a lot of the talk about tariffs is a negotiating tactic. It's designed to, reward friends and punish enemies. And I think that there are a lot of companies lining up to get exemptions from tariffs. But if tariffs are put in place, it's going to raise prices on consumer goods, plain and simple. So, Kathy, I see your hand up.
Hey there. Question about Social Security. Every few years you keep hearing it's not gonna be there, it's not gonna be there. I've actually heard some financial advisors say, I'm telling some of my clients, and I don't know the age cutoff, whether it's 60 or below or 55 below, to not even count Social Security in their retirement portfolios anymore. That if it's there, nice. If it isn't, we're not counting on it in our calculations for you. I'm curious what you think about that.
Yep, it is definitely something that has come up. I think with some of our younger clients, and again, I'm not sure what younger means. And I think, Brianna's on the call here, and I think it's safe to say, Brianna, that you're not counting on Social Security for your retirement. Max is a bit older. I'm not sure if Max is counting on it, but I suspect that Max is on the bubble, and I can tell by the look on his face that he's not counting on it. So, I don't know. Well, let me take a step back, Kathy. I think that what's likely to happen is there's going to be this pressure to privatize. Um, and what does that mean, right? It's going to shift from a type of insurance that was originally set up to be a safety net. Because 100 years ago, if most people did not retire, right? And the retirement age was set at 65 and life expectancy was about 57. So it was never supposed to be retirement savings. It was supposed to be an insurance policy for the small handful of people who got to 65 and lived another couple of years, so they weren't living in abject poverty. The structure is going to have to change in some way, shape, or form. It's more likely that we'll probably transition to some sort of incented savings program. We're already seeing it, right? Some of my posts on Secure Act and Secure 2.0 and a lot of there are about I think it's 92 changes that come out of Secure and Secure 2.0 to retirement savings. And they don't affect everybody. Not all 92 affect everybody, but everybody's affected by something. And we're going to continue to see incentives in education to get people to save for their own retirement. So I would say anybody who's retired now, you know, I would, I cannot imagine a scenario in which we are still a democracy and Social Security does not exist for anybody who is currently retired. I suspect that I would say anybody over the age of 55 is I'm sort of picking numbers out of the air a little bit based upon my experience with when things get grandfathered and what I think is politically palatable. So anybody over the age of 55 can probably count on the system as we know it now. They will do things like increasing the wage base to increase the funding, right? The wage base is the amount of our income for those of us that are still working that we pay Social Security taxes on. I suspect that's going to be the easy one to adjust. That's going to go up quite a bit. The number right now is in the $150,000 to $160,000 range. So raising taxes on people that are already making $160,000 is going to be pretty easy for most people in Congress. So we're going to see that. You know, Medicare, there's no limit, right, on how much income you pay. We pay Medicare taxes on. So I think that's more likely to happen before they start dismantling the system. But can expect there to be continued incentives to gradually shift the responsibility to individuals, just as we get rid of pensions. It's all about shifting the responsibility for planning for financial independence. So, Kathy, I don't know if that answers your question or not.
Yes, it does. And I guess I'm hopeful, a little bit hopeful well, I'm glad I'm 65 almost. But I'm hopeful that you say there are changes to the system that can be made. And I hope that Congress has the political will to do so. And yeah, I'm glad it's not quite so absolute as there's never going to be Social Security anymore, you know. So, and I recognize it's completely uncertain depending on the political will of people. Yeah.
Yeah, I think, you know, one of the things that I've talked about over the years, trying to educate, is that providing some context about what Social Security was designed to do, and who it was designed to serve. There's a complicated calculation, right? Nobody knows the black box, but when I was doing my CFP work, we had to know it and memorize it. We tested on it. So I get the gist of it now, right? I'm sure Brianna can talk more about the specifics than I can. But the concept is they take your 35 years of earnings and get this average monthly earnings indexed to inflation. And the first, I'm going to call it $900 a month. So if your average earnings over that 35-year period work out to $3,000 a month, the first 900 is like 75% of it gets replaced with Social Security. And like the next 500, they replaced 50% of it. And then everything over 2,500, they only replaced 25% of it. I mean, it's that type of structure, which means it was really targeted as an insurance for lower wage earners, right? To replace a larger percentage of their income because they were the most at risk of living in poverty as seniors. The expectation of what it does has morphed, right, to be this entitlement and a form of saving for retirement. And things are going to have to be done to address that mindset. You can't address that mindset fairly or effectively with people who have spent their entire working careers believing that that's what was going to happen, right? So that's why you're going to start with younger workers. The kinds of changes that would have to be put into place would affect younger workers disproportionately to older workers. I mean, for sure. And that's fair for a lot of reasons. I don't know what the best solution is. I don't know if we're going to have the right people in the room in the next 4 or 5 years to have the kind of conversations that need to be had. So the more likely solution is the kicking the can down the road kind of stuff, which will be raising the wage base and then pushing back the full retirement age, which is going to go against the concept of why it was started, because lower wage earners tend to have shorter life expectancies because they tend not to have as good access to healthcare. But that's going to be the more temporary solution. But yeah, I would, if I were doing a financial plan for Brianna or Max today, I would probably suggest they not include Social Security in their plans because it may exist, but it's not going to look like what it looks like today.
Thank you. And I'm sorry, Brianna and Max. I'm very sorry for you guys, but thank you.
One of the benefits of we span 4 generations at Prism. And so that allows us to look at these issues from multiple perspectives and bring those to bear. So what else can I answer for you? John, is that a question?
Yeah, it is. Can you hear me
Okay.
okay? Can you hear me?
Yes.
Okay. The question is Social Security as well, but I'm going to look at it from a different angle.
Okay.
Are there any concerns right now? Because I'm kind of on the bubble right now. I'll be 66 in 2025. And one of my concerns with this new administration and this Department of Government Efficiency is that they may raise the age. Right now it's 66 and 10 months for me. So, sitting on kind of a fence, and, I'm not here to talk about my personal portfolio, but for those of us out here who may be on that fence, I mean, there's some concerns that waiting another year could truly impact us. And we know it's all based on, life expectancy and so forth. You talked about that formula. So, I mean, what do you tell us that are really sitting on the fence right now? Take it, or kind of do your best to ignore this DOGE and these bananas, making all these crazy, new plans to save government money, because I have concerns.
Well, and understandable. I didn't spend a lot of time on my hopes and fears page, but as I've said to each of you when we have our risk conversations, I guarantee you, after you've exhausted what you think, or the bad scenarios, I'll come up with 3 more. So I'm imagining lots of really bad things. But I can tell you that based upon what's happened in the past when they've made changes to those ages, well, one thing is DOGE's recommendations are not due until the middle of next year. Okay. So that's a very interesting tactic. So nothing's going to happen quickly, right, with them. They'll throw out some ideas. There's probably a lot of trial balloons. There's going to be a lot of press about stuff, right? But they have no power, by the way. In order to change the full retirement age, Congress has to change the law, right? So there has to be a change in the law that Congress has to sign on to. It has to pass the House and the Senate and be signed into law. Typically, it has then phased in. When they moved it from 65 to 67, it phased in over a 20-year period. That's why you've got like 66 and 10 months and 66 and 9 months and all of these different things. So the likelihood of, and again, anything can happen, right? But I'm pretty confident in betting that whatever comes down the road is not going to affect you. So I would not make, if someone is, if someone is over the age of 60 right now, I feel very safe saying if you're over the age of 60, don't make your decisions based upon what you think is going to come out of this administration. So this is what I mean about things taking longer to happen. Another way of looking, there's a lot of speed bumps to making changes in certain things. There's going to be a bit of an uproar when when proposed legislation to raise the retirement age comes out, right? AARP, I'm sure, is stockpiling and they're reaching down into younger populations for their membership. The age to join AARP, I think, is still 50. And that's one of the reasons that most of the changes that have happened over Social Security have only affected people younger than 50. because AARP is one of the most powerful lobbies in the country, right, on behalf of so-called seniors, and they consider seniors, at 55, you're considered a seniors because the AARP will take your membership and lobby on your behalf. So it's not just, oh, don't worry about it because I think, it's all copacetic and Pollyanna. It's because there will be changes, okay? But you're not in the population that's going to be affected by it because you're too important a voting bloc.
Here's my only concern. What did you tell us earlier that all politicians fear the most?
Not getting reelected.
That's right.
Yeah.
And what did people like Elon Musk say that they would do to politicians who don't play ball? They would primary them and get rid of them. So they're going to be stuck between a rock and a hard place to either support the administration or possibly not be elected. That's my concern. The game's changed from past administrations who never threatened candidates that way, and they've got the money to do it. That's one of my biggest concerns right now, the leverage.
Well, and it's a legitimate concern, but I will tell you, it has been going on for a while. The threats of we have been, I would argue, since this goes back to the Newt Gingrich days, okay, which is the 1990s. We have gradually seen both parties subjected to being primaried from further to the left or further to the right. Okay, so this is not a new thing. I think they're also going to spend their money on other issues because at the end of the day, they care about money more than they care about anything. It's funny you talk about Elon Musk. One of the things that's been floating around in my head for the last 4 or 5 days is recognizing that he was not raised in this country. He does not value democracy the way we do. Okay, he comes from a different culture that values minority rule through economic power, and there's a lot of stuff that goes along with that. And I think it is going to have an impact because he is such a powerful advisor. But it's still going to come down to money. Okay. And the people, the pressure is going to be placed not in areas that are not going to make these people money, if you think about it that way. What does he have to stand or gain financially by pushing through Social Security legislation? They're going to use their political capital to reduce corporate taxes, to reduce regulation, to make permanent the estate. I mean, that's where they're going to use their political capital. They're going to they're going to want to see legislation, right, that is going to slash corporate taxes to levels that people can't even imagine right now. That's going to gut government agencies and get rid of regulation. Okay, SpaceX is being investigated for the environmental impact of the rockets in Texas, right? They're going to get rid of that. So I think that's where they're going to use their political capital. I mean, why are they going to primary anybody on Social Security legislation? What do they have to gain by it? So it's a very cynical perspective, but when you have oligarchs, because that's really what we're talking about at the moment, right? Oligarchs care about their own bottom line more than they care about anything else. So unless there's some sort of economic interest in it for them to want to use their political capital on that piece of legislation, I think it's a great headline, but they're not going to use their capital that way.
Let me follow up with just one more and I'm done. Okay. Social Security, once again, Connecticut takes a tax from Social Security. Trump has come out and said he wants to end tax on Social Security. Do you think that's going to happen? Where we in Connecticut who take Social Security will no longer be taxed on it?
Well, okay, but Trump is part of the federal government, not state government. We have a separation of state and federal powers in this country. they're not going to make state taxes on Social Security illegal. Okay. So right now, the maximum amount of your Social Security that's taxed at the federal level is 85%. Most states have some sort of window for a certain amount of retirement income that is not subject to state taxes. Like in New York, you can take 20 grand out of an IRA that's not subject to taxes. I don't do taxes, so I forget all the nuances. Even if they eliminate federal income tax on Social Security, they have no power to stop Connecticut from charging taxes on Social Security.
Okay, that's what I thought.
Yeah.
I just wanted to kind of throw it up there and confirm that they cannot stop the state from taking taxes on.
Yeah, I mean the kind of could you try? I mean, they can try. The reality is there's going to be a lot of testing of limits, frankly. But that's not going to be the one they're going to pick.
Okay, I'm good. Thank you.
Yeah.
Very
Okay.
much.
So you're welcome, John. Other questions?
I do, Juliet's friend.
Hi.
We, as you know, we have two boys, early 40s and late 40s. They have for 20 and 21 years been paying Social Security tax out of their checks every month or week, whatever it is. So are you saying or thinking that there will be some type of transition for them, being that they're not 50, yet they have all their careers been paying for this? And they're at the age where you're saying they can't use in their formula for retirement Social Security. So with what you said about education and teaching people now they have to increase their savings for their retirement, where does it put those people, just like the 65-year-old who doesn't want, the gentleman that just finished talking? Will there be something for the younger set that are not 50? Do you think? I know you don't know the future, but do you think these oligarchs will have a little compassion?
Okay, for the last question, I'll send you to Webster for the definition.
No.
But to answer your questions about the boys, so what's most likely is some sort of transition, right?
Okay.
That is what has always been done in the past with any of these kinds of changes.
Correct.
I'm comfortable talking about things like over 50 and under 40. That 40 to 50 range is vulnerable. And the reason they're vulnerable is because there's going to be an age that gets picked when these changes start to phase in. And the people that are sort of just one side of the line or other are going to have the hardest time. And that's just a reality. And whether you pick it at 45 or 50, so the more that we can do, and this is whether there is such a rise in financial planning, and some of the, JP Morgan has put out some charts, and I've got them in some of my blogs that show, in order to be on track for accumulating money, right, to replace your income in retirement, how much should you be saving out of your paycheck? How much should you have accumulated at different ages based on different incomes? And we're doing more education about that so that younger people, and we're seeing this in the Gen Z population, right? And I'm not going to ask Brianna to speak for her entire generation because she's right on the too. But they're better savers, right? They have no expectation that anybody is going to help them with anything. And they're doing it themselves. Right. And so there's a much higher level of financial literacy amongst younger generations because of that. So The boys are, they're going to be on the cusp, and it depends upon when this legislation happens. And if it's phased in properly, they're going to have 20 to 25 years to plan for this. Because the other piece that we haven't talked about much at all, but that is part of this mix is that retirement isn't what it used to be, right? And in some of my blogs, I talk about substituting financial independence for retirement, because you and Steve both went to work at places you expected to stay with the same employer. There was the social contract of, I work, I accumulate pension, benefits, and so forth. And at 65 is this target retirement age, and maybe I can go at 60 or 58 in early retirement. But what younger generations are doing is changing that whole framework. They're not thinking in terms of working hard until they're 65 and then stopping working and making that this very binary type of choice. It's more about, they have more experiences younger, right? They're focusing on quality of life. And I know these are very broad statements. So, forgive me, but their entire view of what their life is going to be like when they're 60 or 70 is very different than the way you imagined your life would be at 60. And most of them will probably continue doing something because they can't imagine just sitting doing nothing.
True.
Okay. Now there's a point, there's a line, and every family is different, every person is different. These generational things are affected by multiple things. The fact that you and Steve both worked for employers that were among the last to get rid of pensions, that their mindset is more, they're going to struggle with it more than, there are other people in your age group who worked for employers who had gotten rid of the pensions sooner, right?
Right.
And so their kids saw the end of that era at a younger age. So they started preparing to adapt to it sooner. Does that make sense to say it that way?
Yes.
Right. So there's going to be degrees of it. But yeah, they should be planning to save and accumulate and make choices now about, where they want to be in 20 or 25 years financially, and take on more responsibility for it and not expect something to come back to them. Because even if there is Social Security,
Right.
it's not going to replace probably more than, I would guess, 15 to 20% of their income, if they're lucky.
Right.
Yeah. Yeah.
So if
Julie,
they want to maintain their lifestyle, they've got to start planning for it themselves.
Well, when Steve retired, they gave him an option, and we discussed this, and I don't know if other people in the meeting now had the same option, was take a lump sum or take your monthly pension coming into the house. So that is, I'm thinking that might still incorporate all these younger people, the 40-year-olds that are,
Nope.
They won't get that option?
No.
Nope.
Oh,
short
okay.
answer is no.
Okay.
Julie, I got a quick one, kind of along the same lines as what John was saying in respect to being primaried and scared. My concern is that all of these people that have been primaried, the talent that has come in to replace them, in my estimation, are totally ineffective. We've seen how well they did last time around with the 118th Congress. We could hardly get continuing resolutions off the floor, couldn't even get a speaker elected.
Yeah, but
and what's the chances of them? There's individuals in that group that are basically looking to burn the place down, and how volatile this government can be and how that's going to affect the markets. I realize what you're saying. There's a lot of pressure with the businesses saying they don't want to go there either. But the people that are sitting in some of those seats don't care. And that's what concerns me.
Markets like, I'm going to say stability. And what I mean by that in this case, because it's not that it's stable, but what the market's going to look for is that, is there a cohesive movement to bring about change? And what you're describing, right, is the antithesis of a cohesive movement to bring about change.
Mhm.
The fact that, I mean, the House is going to be, what is it, 4 or 5 seats?
Right.
4, I think, yeah.
So the markets are very, very happy to see a very evenly divided House of Representatives and Congress, because it means that very little is going to get done unless there's a bipartisan aspect to it. So the way when we think about functioning, it's probably not going to function very well, in that they're not going to get as much done as they could, right?
Okay.
Because of these factions. But that's actually the best possible outcome from an investment standpoint. And the markets are very happy about that.
Okay.
Okay.
We're in for a ride.
Well, yeah, and that's, the chaos is exhausting. Um, Keeping in mind that there's going to be a lot of noise, right? A lot of sound and fury. There's definitely going to be changes on the personal side. I had a conversation with a family member the other day, and I'm facing the reality that I think the Obergefell case is going to be struck down in the Supreme Court, which means other states are not going to be required to recognize my marriage, right? So if Patty and I are in Florida visiting my dad, and God forbid something happens, we're legal strangers. Florida will have a law in the books that will not recognize my marriage, right? And there are implications of that, and that we have to prepare for, right? It's kind of going back to the way things were before. And there are going to be things like that in our lives that are going to affect society in general, that
Yes.
we're all going to have to grapple with. That's just a very personal one for me. But economically, I think, as I've looked more closely at the laws that are on the books now and what has to happen, okay, things like electing Thune in the Senate, right, as opposed to Scott. Musk pushed for Scott, Trump was silent, right? The Senate elected Thune. So the messaging is the Senate is still taking seriously, for example, its role of advice and consent. We have checks and balances in the system. There are people that believe in using those checks and balances. We are not going to see a lot of it, because they don't want to draw attention and see the retaliation that's going to come. Okay.
Right.
This whole
Right.
process of getting all of these cabinet proposed announcements out there really early has allowed, the trail balloons, right? And there's a lot of posturing. So it's going to feel very chaotic. But when you look at what the mechanics are to change things, okay, the fact that they're not going to be very functional is really the best possible outcome for us.
Okay.
Right? Because from the markets and the economy standpoint, that's going to give us the most stability. So the headlines are going to be, the news is going to be crazy, right? But the markets are going to be very positive. Market's going to like it.
Turn off the TVs.
Yes.
Yeah.
I mean, the
Julia,
latest thing, I mean, at Bloomberg this morning, and and I just kind of have to roll my eyes, because I watch my local news early, and then I put Bloomberg on, and then it's usually off by 7:30, right? Because the smartest people are on before then anyway. But they were actually talking about the stuff with the drones. I don't know, for those of you who are
Yes.
in the New York metropolitan area, are you aware that we're dealing with these drone sightings?
Yes.
And they're actually having a serious conversation. Are we being gaslighted, right? What's really going on with the drones? Is there some sort of conspiracy? And it's amazing to me how we can end up being distracted by these things. And look, I can think of a bunch of scenarios with these things,
Right.
I don't know what the truth is going to turn out to be, but we will be exhausted at following the bouncing ball,
Mm-hmm.
and we're all really, really primed to see conspiracies around every corner
Mm-hmm.
and ill intent around every corner and malice around every corner. And so to the extent that we can take a step back, and not get drawn in to that energy, I think is our best way to get through. In the next 6 months, I don't, I think, where are we now? For how many days out from the inauguration? 40 days out, 38 days out from inauguration.
Mm.
There are some definite worst case scenarios I can imagine in my mind that could happen on January 21st,
Don't share
right?
them.
But really unlikely to happen. And the kinds of things that would have to, because I'm seeing 3 and 4 steps out. We
Right.
will have much more information by the end of March about what to expect for the rest of 2025. Today, it's all speculative. It's a parlor game, right? We all have these bingo cards of all the strangest things we think might happen. And it's almost become this energy feeding on itself of trying to think of the most outrageous things that can happen, right?
Right.
Look, there's going to be a lot of stuff that as human beings we're not going to like.
Right.
It's sad. They're going to affect people in our lives, right? I mean, we're going to see that stuff. Each of you is in a situation where economically, you're in that top 10%. Okay. So you have an economic interest in what happens in a way that probably 90% of Americans don't. Remember, 90% of Americans are spending 98% of their income on they're consuming 98% of their income. So you've got this conflict, right? Where the economic side of things, which is in all likelihood, from everything I can see, going to be good in 2025, is going to benefit you while we're dealing with some of the other things that we're going to be sad to see.
Okay.
So that's probably one of the challenges you're all going to face.
Thanks, Julia.
So you're welcome. What else can I answer?
That's it.
Okay. All right. Well, I just want to make sure there's not anybody else who's, trying to do the unmute thing with Zoom. So, thank you all. Thank you for taking the time tonight in mid-December. I know we're a little closer to the holidays than I usually like to be for these, but I appreciate you taking the time. Appreciate your ongoing confidence in us, and your loyalty as we get through these challenging times. We are here for you. Feel free to follow up with any questions or any thoughts or any feedback. I want to make this time valuable for you as well. And we'll be doing some things as we get into early 2025. I'm going to be sending out more. I do publish a newsletter every month, and I've got a lot of blog posts out. It's been kind of a soft launch as I've built some content on the website, but I'll start letting you guys know when I publish that. Just trying to share some of my thoughts. You know that I can talk.
You're not charging us for that service, are you?
So I am not.
Yeah, that's going to be great.
Just checking.
All included. So, but yeah, most of you should have gotten links for I started doing some more frequent posts after the election. But there's a bunch of stuff on there, and we're going to be rebranding some of it. I got some feedback about some of the fonts that we use they're not always the easiest to read. So we're working on changing some of that stuff too. So any thoughts and feedback you have, anything you'd like to have me write about or talk about, we do have a post, Steve and Kathy, that actually has tables, one of them in there. And if you remind me, send me an email, we'll send you a link to it for the boys that shows, for example, based upon different ages, and different income levels, right? What is a target savings rate for somebody who wants to plan for financial independence, right? How much should you have in savings? So we're seeing this increase in education and how to benchmark ourselves, right? Where should we be? We're trying to get more information out there. So I'm happy to share that. But I thank you all again. Wish you all a safe and happy and healthy holiday season in 2025. And we'll see you next year.
Yeah.
Happy holidays, everybody.
Thank you.
Holiday.
Thanks.
Good night, everybody.